Let's talk about the accounting equation. At any given time, the rules of accounting say that, or state that, the total of all the asset accounts must be equal to the combined totals of all of the liability accounts and all of the owner equity accounts. So now let's talk about some of these accounts. Under assets, we always see the cash account. We would often see an accounts receivable account. Or we often refer to that as AR. AR is accounts receivable. Those are amounts that are going to be received by the company. And then often we'll have a supplies account. So supplies are the asset account. This is different from supplies expense. These supplies are those items that you go purchase at the store, at the warehouse, and you bring them and you store them in the cabinet or the closet, and they are an asset for the company until they are used up. When they are used up, or we'll just say used up for now. When they are used up, then we prepare an adjusting journal entry that will bring that account up to date. So watch for a video on adjusting journal entries to help you understand that. So this is supplies, the asset account. Those items have not been used up. Often we will see accounts that are called prepaid expense accounts. So do not be fooled by this account. It has the word expense, but it's that word prepaid that is really our clue that this is an asset account. These are amounts that are paid in advance. So you can think of prepaid insurance, prepaid rent possibly. A company has paid in advance and will use up, or some of that will expire as time goes on. It's not uncommon at all for this to happen. So prepaid expense, all of these are asset accounts. Let's talk about different types of liability accounts. So as opposed to accounts receivable, a company could have an accounts payable. So those supplies that were purchased might have been charged. If they were, we'll call this accounts payable. So notice AP instead of AR if you're seeing abbreviation. Wages or salary that has been incurred, the company actually does owe for the wages but have not been paid yet, would be a liability. Notice the word payable. All of these payables are going to indicate to you that this is a liability. Note payable, mortgage payable. There's another unique type account called unearned revenue. Unearned revenue, don't be fooled again by the word revenue. It is this part unearned that causes us to classify this account as a liability type account. These are for amounts that are received in advance of performance of some obligation. Think of if you're going to get a flight to go across country, you buy that ticket in advance many times. Has the airline actually earned that ticket money? No, they have not. They will earn it when they fly you across country, right? So they are holding that cash in advance. Likewise, if you pre-purchase a ticket to go to a concert, the same thing, you purchase in advance. Well, many times this happens in business in other ways as well. Some deposit or prepayment will be made, but it has not been earned yet. And so we call this unearned revenue. It is a liability account. And then when we prepare journal entries later at the end of the period or end of the month, then we will recognize, and hopefully some of that will have been earned at that point. So we have some asset accounts, we have types of liability accounts, and then let's talk about our equity accounts. There are two different components. One is called paid in capital. Paid in capital are those amounts that have been paid in or given in the form of an asset, perhaps trade a building or something like that, equipment, and ownership is given in return. So paid in capital. Common stock falls under this heading. A company could have preferred stock and multiple degrees of stock. If they have only one, common stock will be there. You might also see this called capital stock. It's the same thing. The other component is retained earnings. Retained earnings represents those amounts that have been earned by the company and are still in the company. How would they not be in the company's possession? Perhaps they might be paid out in the form of dividends. Perhaps losses occur along the way. That would be a subtraction as well. But typically we think of retained earnings as being those profits, earnings that a company has earned and has retained. Let's think about yourself. So if you own, let's say you have a car, and that's an asset for you. Let's say that I ask you if you own this car, and you might joke and say, oh, the bank and I both own that, right? We own it together. So we account for the fact that you own the car here as an asset. We account for the fact that you owe on this car here with the bank payable. So you still own this car, and the fact that you owe for it would go under your liabilities. And then if you have some, some equity in that car, let's say your car is valued at $20,000, and let's say you owe now at this point $10,000 on it. Well, you have some equity in the amount of $10,000 here as well, that leftover amount, because we have to be balanced, right? So the total of this asset is $20,000, must be equal to the combined total of these two items, which is $20,000 in this simple example. Double rule or double underline means we're in balance and everything matches like it's supposed to. So these two items together must equal up to the total of the assets. I'll just put owner here, owner equity. And again, we would call that capital if it was a sole proprietorship. And we're talking about corporations most of the time in my lecture, so we're talking equity, shareholder equity, stockholder equity. Assets are those things a company owns. Liabilities are those amounts that are owed by the company. And then the equity would be the owner's claims to those assets. Let's have a brief look at the expanded accounting equation, because typically a business is in the business of doing something. They are grossing some revenue, they're earning some revenue of some form, and this could be in the form of sales revenue, it might be consulting fees, it could be any number of things, and a company could have multiple types of revenue. So as you read through your textbook and other research, just begin to identify what the revenue is for this business. What are they in the business of doing? That is the gross amount. And then there are going to be some expenses typically associated with the earning of that revenue. So expenses are the cost of doing business. Dividends are not an expense of the business. They are amounts that are paid out to the owners. And this is a little hard to understand sometimes, but a company does not have to make profit in order to pay out those dividends. Ideally, they should, we would say, but they do not have to. So let's look at some examples here. So for your revenues, this again could be your sales. We'll just say sales in this case. And then expenses. What about the expenses? We could have office expense. This could be maybe the supplies that we've used up. We might have wages, the expense account. Let me add the word expense to both of these. So these are all expense accounts, and they're typically identified like that. We'll know that they're an expense because they say expense, with the exception of there's an account called cost of the goods sold, and this holds the cost of goods that have been sold by a company. Okay, got that corrected now. So cost of the goods sold, that would be the cost of the merchandise. If a merchandiser is in the business of bringing in goods, like say Walmart, they bring in goods and they sell those goods, then they're going to have a large account called the cost of the goods sold, which is going to be pretty significant. Doesn't have the word expense on it anywhere, but it is a large expense account for them. So any number of expense accounts, there are usually quite a few of those. So the revenue minus the expenses, when we look at that relationship, we take the gross sales and we minus or subtract those expenses. This is where we find our net income. This is when the sales are higher than all of the expenses combined. Now, if for some reason there are more expenses Then there are sales revenue. And let's just say our sales is, let's just pick some numbers here, 100,000. And let's say we've totaled up all of the expenses and they tally up to be 75,000. Then we would have a net income of 25,000. However, if we had the different scenario so that let's say sales were 75,000 and let's say the total of all of the expenses were 80,000. Now we have a case where there are more expenses than sales revenue. This is going to represent a net loss for the company. And many times we'll see that represented in parentheses. So we always hope this doesn't happen, but it could happen. Okay, so again, we're hoping for net income, but it could be net income or loss. So when we write it like this, net income and loss in parentheses, that means it's one or the other. It is not both. And then for dividends, dividends again are not an expense. This is just a return to the owners on the investment. So not an expense account. Okay, that's enough for this one on your accounting equation and expanded accounting equation. Please watch for the next videos. I think there will be one on adjusting entries and also on calculating the retained earnings account.